Hello viewers, this is Coach James with another edition of the Wealth Coaches and our Wealth Tutorials education series. Our website is www.thewealthcoaches.com and our YouTube education channel can be reached from our homepage or by visiting it directly at http://youtube.thewealthcoaches.com. Today we are discussing what's driving gold. I found this excellent interactive website resource at www.usfunds.com/advisors/WDG. This chart explains to the average investor some of the many causes, effects, and possible ramifications that can drive the price of gold higher, as we are seeing in the markets right now. The first cause is the growth in world money supply. Years of easy monetary policies by central banks, and now the trillions of dollars in economic stimulus to fight the global recession, has led to inflationary pressures. Although we're not seeing it at the moment, the excess cash in the marketplace will eventually tend to bid up prices for goods and services. So this could result in declining confidence in paper money. History teaches us that the prospect of inflation lowers confidence in paper money as a store of value, leading many investors to buy gold to preserve their wealth. So this is one cause of what could lead to higher gold prices. Second is volatile stocks and oil prices. After several bull market years, stock and commodity markets turned down dramatically in 2008 as the global economy slid into recession. While markets have partially recovered from their lows, they remain volatile and many investors remain focused on capital preservation. The effect of this is a safe haven appeal. While other hard assets like real estate and commodities have lost value, there was a revived appreciation of gold as a safe haven for investors seeking to protect themselves during difficult times. So this increased the demand for gold. The recession of 2008 created a large new class of gold investors. The strong demand exerted by this group, along with traditional gold buyers, drained the global inventory of gold coins and gold bars, thus driving up the price of bullion at a time of shrinking worldwide production. You've probably seen a lot of the late night infomercials looking for gold and even silver jewelry to turn into to cash, and the smelters of this gold are doing it for this reason. There's a lack of supply for gold right now. Third is China. Gold has long been prized in China, which is one of the world's largest producers and consumers. Increasingly, China's gold market has become more liberalized. So the effect of this is to have a trade surplus. China has huge trade surplus with the US and Europe, and that generates vast quantities of foreign currency. China also has one of the world's highest savings rates. So the effect of this is to rotate into commodities. China buys a considerable amount of US government debt, but it is diversifying its reserves by increasing its holdings of gold. In addition, China is pursuing investments to recycle its dollars into natural resource projects. Again, this could result in higher gold prices. Now, the low gold price in the 1990s, after climbing as high as $850 an ounce in 1980, gold dropped as low as $252 an ounce in 1999. So the net result was a cut in exploration for new gold reserves. Low prices and environmental controls discouraged mining companies from spending the money to find new supplies of gold. So falling production was the outcome, and the lack of investment during the low price years meant that new supplies of gold had not kept pace with global demand, thus driving prices for gold much higher. Fifth is low interest rates. When real interest rates are low, many investors turn away from paper assets with declining value and instead turn toward assets with real value like gold. The effect of this can be that hedging is curtailed. When interest rates are low, there is little incentive for hedging. As a result, gold is removed from the markets. The ramification is less supply. So a decline in hedging shrinks short-term gold supply, thereby creating a market imbalance during a time of escalating demand. This is why gold prices have moved higher. And finally, the credit crisis. The U.S. economy has been hurt by tighter liquidity associated with heavy losses in the key housing and financial sectors. The effect of this has been an interest rate cut by the Federal Reserve. and they've effectively cut rates to zero in an effort to lift the economy out of recession. And currently it's projected they will continue this pattern of low interest rates until 2015 or 2016. The result will be a debasement of the US dollar, so the weaker US dollar, rate cuts driving down returns for currency investors. Many of those investors will buy gold as an alternative reserve asset, thus driving up demand. And that is another reason we can have higher gold prices. To find out more about our business of wealth coaching and financial education, and to learn how to invest more profitably by studying financial history and geopolitical economics, simply visit us online at www.thewealthcoaches.com. Be sure to register as a member so we can update you when we release our next wealth tutorial and our member-only newsletter. Until next time, this is Coach James suggesting that you learn and grow wealthy.